Welcome back to Brassionomics, here with Glen at Thiessen with Transition Planning Inc., who really helps a lot of families plan ahead for the major transitions in life with advice and securities through KMS Financial Services. Well, first, it's good to see you, Glen. You know, I always love having you and discussing the ins and outs of some of the financial, the financial minefield people have to navigate through, it seems like.
There's a lot to it, Ben, and it's good to be back. And one of the interesting things I'm going to add to this segment is a tax minute at the end of my program. But today it's going to be more of a tax few minutes because I'm going to tell you a little bit of a story about how the tax code is explained in terms of beer. So that should be kind of interesting. But before we get to that, let's just talk about the 9 kinds of money. Again, we're talking about new money, that's your income. How you use that effectively will impact your future. We've got additional money. When you've got a tax refund, what do you do with that? Do you go out and spend it, or do you invest it? Right? There's the old money that's sitting around. How effective is that? Where it's sitting. So you've got returns, interest, dividends, capital gains, rents. So when you're dealing with real estate, you might have rental incomes. So then there's the need money. How much do you need in a particular drawer to take care of those future planned major expenses, or even for an emergency fund? So then there's no money. That's the situation where you actually have all of your income spent before you even receive your paycheck. That's a bad situation, and that's actually the situation the government's in right now.
There you go.
You might have noticed that. So then there's tax savings. If you do invest in your 401k plan, or you put money into an IRA account, you got tax savings. So what are you going to do with that? Are you going to go out and spend that, or are you going to actually invest those tax savings? And then there's the coordination. Coordination is how do you make more efficient use of your money. So, for example, and this is the hard part, I think, for people to do on their own. It's easy to look at your savings account.
Yeah. It's easy to look at your 401k or your tax, in these what I call silos.
Right.
It's a whole other thing to maximize it or coordinate, as you say.
Exactly. So if you're risk averse and you have a whole lot of money in cash, but you're going to share that return with the government, what if you were to move that into a tax deferred type of savings where you got a fixed interest return, but it's tax deferred until later on when you decide to take it out? So there are ways that you can actually use your savings drawer more effectively. So that's coordination. Integration is where we start getting into the multiple use of a dollar, where $1 can do much more than just one function. So, for example, in addition to tax deferral, what if you were to also get like insurance benefits? So, for example, if you have surplus cash, but you don't yet have long-term care protection, for example, and you wanted to get some tax deferral, you can move some of that cash into a tax-deferred annuity that's designed to pay long-term care expenses. So now you're getting tax deferral, you're getting a higher guaranteed minimum interest rate, 3%, 4%, whatever, heck of a lot better than the bank, and you don't have to share it with the government every year. Plus, if you have to use long-term care in the future, basically that's where it's going to come back to you tax-free, not taxable. You don't have to take money out of an IRA account. So basically, knowing the benefits and structure of different ways of storing your cash is so effective, so important.
I mean, and you talk about 9 different drawers, that you really do have to know about. Mm-hmm. How does somebody go about managing these things? I mean, how does somebody do that?
Well, what I do for a person is I chart it out. So we look at how is everything structured right now, and then we look at the alternatives. Where can improvements be made? Does it make sense to make any of those improvements? So it takes a piece of paper where you can chart it out. It's very simple. You got these different levels of benefits. Are you getting interest, or are you getting?
It looks very simple based on the chart you brought that has 25 squares.
Yeah. So, for example, in the real estate business, as an example, what if you had cash and you wanted to get capital appreciation? Well, you're not going to get that in a savings account or a fixed interest annuity. Capital appreciation is taxed at 15% this year. Next year, it's going to be 20%, but that's a heck of a lot better than the highest tax bracket. So if you're looking for capital gains, real estate is a great way to get that appreciation over time. It also might involve leverage. Well, that's tax benefits, right? So you might be able to get depreciation right off, which you can't do in just a mutual fund, right? So you can get rental income. So, for example, you're getting tax deferral, you're getting capital gains, lower tax rates, you're getting depreciation, you're getting rental income. So just knowing the different levels of benefits that you can get out of different types of assets can really help to maximize your wealth over time.
And when you start understanding all of these things, and you start really being able to, I guess I would say when you even know what they are. I mean, that's kind of that first point.
Right.
You know, I guess it's always interesting just to get the vocabulary.
Yes.
Like, yes, I would like that. I would like more appreciation and capital appreciation. I'd like to pay less taxes.
Sure.
You figure that all out, but then you have to be able to execute. It's one thing to figure it out, I guess, in your analogy, to know where the drawers are.
Right.
It's a whole other thing to figure out how to fill them and where the money's coming from to put it in the drawer.
Sure. So, like, for example, if you had surplus savings or whatever, and you wanted to get some capital appreciation in a very diversified manner in the marketplace, you can just simply invest in a mutual fund or something like that. But you can also do that on a tax-deferred basis inside of a variable annuity. So
taking money out of savings drawer, and then you have choices of which drawer to put it in.
Exactly.
Based on
the types of benefits you're trying to get. So, you know, again, getting things taxed at a 15% rate versus 20 or 35, whatever, is much better. So, talking about taxes, I've got a little allegory here just to give you an idea of how the tax code works. And I'm going to explain that in terms of beer.
Okay.
So this is, suppose that every day 10 men go out for beer and the bill for all 10 comes to $100. If they pay the bill the way that our taxes are paid, it would go something like this. The first 4, the poorest men, would pay nothing. The 5th would pay $1. The 6th would pay $3. The 7th would pay $7. The 8th would pay $12. The 9th would pay $18. And the 10th man, the richest, would pay $59. So that's what they decided to do. The 10 men drank from the bar every day and seemed quite happy with the management until one day the owner threw them a curveball. Since you are all such good customers, he said, I'm going to reduce the cost of your daily beer by $20. Drinks for the 10 men would now cost just $80. The group still wanted to pay their bill the way we pay our taxes, so the first 4 men were unaffected. They would still drink for free. But what about the other 6 men? How would they split up the $20 windfall so that everybody would get his fair share? They realized that $20 divided by 6 is $3.33. But if they subtracted that from everybody's share, then the 5th and the 6th men would each end up being paid to drink. That wouldn't seem right. So
I will leave them.
Yeah. Well, you probably want to be on the upper end.
That's true.
So the bar owners suggested that it'd be fair to reduce each man's bill by a higher percentage the poorer he was, to follow the principle of the tax code that they've been using, right? So he proceeded to work out the amounts that he suggested for each would now pay. So, for example, the 5th man, like the first 4, would now be paying nothing, representing 100% savings. The 6th man would pay $2 instead of $3, saving 33%. The 7th would now pay $5 instead of $7, saving 28%. The 8th now paid $9 instead of $12, saving 25%. The 9th now paid $14 instead of $18, saving 22%. And the 10th now paid $49 instead of $59, saving 16%. So each of the 6 was better off than before, and the first 4 continued to drink for free. But once outside the bar, the men began to compare their savings. I only got $1 out of the $20 savings, declared the 6th man. He pointed to the 10th man, but he got $10. Yeah, that's right, exclaimed the 5th man. I only saved $1 too. It's unfair that he got 10 times more benefit than me. That's true, shouted the 7th man. Why should he get $10 back when I only got $2? The wealthy get all the tax breaks. Wait a minute, yelled the first 4 men in unison. We didn't get anything at all. This new tax system exploits the poor. The 9 men surrounded the 10th and began to beat him up. So the next night, the 10th man did not show up for drinks. So the 9 sat down and had their beers without him. But when it came time to pay the bill, they discovered something very important. They didn't even have enough money between all of them to pay for half of the bill. And the anonymous writer that wrote this continues on by saying, and that, boys and girls, journalists and government ministers is how our tax system works. The people who already pay the highest taxes will naturally get the most benefit from a tax reduction. Tax them too much, attack them for being wealthy, and they just may not show up anymore. In fact, they might start drinking overseas where the atmosphere is somewhat friendlier. So in terms of beer, that's kind of how the tax code works in story form. Hopefully that'll give you a little bit more understanding of how that the split goes between the wealthy and the poor, and who gets the benefits and who really is paying the bill.
Sure. It's always good when you put things in terms of beer like taxes. It makes it very interesting.
I thought you'd like that.
Yeah, I do. By the way, we are here with Glen Thiessen, a wealth advisor with Transition Planning Inc. But Glen, so you start looking at where people lay on the curve.
Yeah.
First, of course, at first I say, well, I'd rather be the guy drinking for free. But when it comes down to it, the guys drinking for free don't have money to go do anything else.
Right.
And the person who's drinking, who's paying and in some ways was okay paying a certain amount, had the ability to go do other things.
Sure.
I'm not saying one way is better or worse, but you're right. Eventually, people might go drink somewhere else.
Yeah, and that would be unfortunate.
And they do. They go to the country club with their other friends, and they split the bill evenly.
So the tax code is changing all the time. And what you want to do is be aware of how you can benefit from it. And it makes sense to use the tax code for your benefit. But those benefits are a little bit more limited for some people than they are for others.
Yeah. Well, and I think it's easy to get caught up in how much everybody else is paying and who's paying their fair share, when everybody has the right to go out and try to create the best tax plan for themselves, figure out what the drawers are, and there's a big point of you got to control what you can control,
right?
Or else you will drive yourself absolutely haywire, right? You can't. Right. What are you going to do? You're going to worry about the tax code?
No.
I mean, you can't.
No, but being aware of it and making the best use of it makes sense for your own wealth accumulation.
I 100% agree. Yeah, and that's the drawers. That's understanding where the drawers are, what drawers you have access to. Because otherwise, and you must see this all the time. You don't control the market. You don't control the tax code. You don't control a lot of the things. You just do control what you can control within those dynamics.
That's right. So just as an example. So for example, the end of this year, we're going to be done with the 7.5% exclusion on medical expenses. Okay. So next year that goes to 10%. So if you're close to the threshold of 7.5% of your just gross income for unreimbursed medical expenses, you might want to kind of do those elective procedures and pay for them before the end of this year, for example. So knowing what's going to be changing the tax code can allow you to use your money and make decisions more effectively.
Yeah, well, maybe that's why there's guys having season-ending knee surgery, huh?
Yeah.
They want to push those procedures up before the end of the year.
Yeah.
Glenn, thanks so much for joining us. Always a pleasure. Again, Glen Thiessen, Wealth Advisor with Transition Planning. When we come back, John Hugg will join us, a good friend of our show. We will discuss a little bit more about planning and estate planning and the ways that you can make sure to keep a little bit more of your money. We'll be back after this break.